Hey everyone, this is Mark Scribner, Managing Director, Wealth Advisor Partner with Carson Wealth. Today, we are going to bring on a very special guest. His name's John Manley from DWS. He's going to be talking about an asset class that has been in the headlines a lot the past couple of years. We're going to talk a little bit about that asset class, where it might be appropriate. This is one of the questions that we have all the time. John, I feel a little boring today, so I was going to kind of adopt a little bit of a Jim Cramer personality, a little crazy, outrageous. But let's tell our audience a little bit about who you are, what you do, and then I'd like to bring up that asset class just to kind of bring that in the kind of the context of what this discussion should be about.
Absolutely, that sounds great, Mark, and I look forward to the personality coming out. So DWS is a global asset manager. Our alternatives business specifically manages about $130 billion globally, and the lion's share of that capital is in private real estate assets. And our private real estate business, specifically here in the U.S., is about a $40 billion business, and we invest across core commercial real estate. So apartments, industrial, multifamily, and retail are sort of our core sectors. And within those, we tend to focus on the largest metropolitan areas in the U.S. So the 30 largest cities, we very much have a coastal bias. And we also look towards the markets that are the fastest growing in terms of population and employment. My role on the team is to distill down what we're doing in our portfolios and in our investment strategies to the market and to our investors. And I've spent most of my career now working in some capacity within the private real estate business.
That's all. Thanks for the overview. If it's all right, I just want to bring up a screen real quick, and this is more or less the headlines. I don't know if can you see this okay, John, this little chart here? Now, again, this is a question that we get quite often. Folks understand, I think, to a large degree, they can own some kind of a real estate asset. And the intent primarily is because they work inversely with the stock and the bond market. So there's another way to have, asset wealth creation in different asset classes. But, as you can see just here, coming into the pandemic, REITs in 2024, that sector that you operate in was the high flyer. And now there's value that's been created post-pandemic with cap tables and things like that adjusted. But maybe for our audience, if you could just talk about like what the advantages of, say, using someone like you folks to professionally manage this part of someone's portfolio versus buying 20, 30 condos and doing the administration and all the upkeep that's required around that, doing it yourself, basically DIY. So what are the advantages with your due diligence and the capital that you have?
Yeah, I think what we really bring to the table in terms of investors looking for uncorrelated returns from the public equity or the public bond market, or that private real estate is priced on the underlying fundamentals of the portfolio. So looking at the cash flows of the underlying assets, and maybe irrespective of the supply and demand, the sellers and the buyers in the public market, we're really trying to understand what is fundamental fair value for those assets. So they tend to have this uncorrelated return stream, more so related to the way in which we go about valuation versus the way in which the public markets go about valuation, between how many buyers are there and how many sellers are there. And that's when you tend to see whipsawing in the public markets, when things become dislocated or there's heightened bouts of volatility. The reality is that typically the fundamental outlook of the market doesn't change overnight. And we take a lot of that noise out of the equation. For investors that are thinking about or have invested in real estate as individuals in the past, going out and buying properties and managing them, what we really offer those investors is broader diversification and the institutional management of those properties. So when a pipe bursts or an HVAC system goes bust or a roof needs replacement, there isn't that need for John Manley to run down the street and fix the problem or be calling contractors and actively managing those issues. So we offer broader diversification, not just single family rentals or small unit rentals, but we also invest heavily in the industrial sector, heavily in grocery anchored retail, and those tend to be properties and investment sizes that are out of reach for the lion's share of individual investors. And because we have such a large investment portfolio in the US, there's a lot of signals that come off of that portfolio. We manage $40 billion across those four sectors I mentioned, being industrial and multifamily, office and retail. There's a lot of signals that come off of that allow us to manage the portfolio efficiently in terms of what are we buying, what are we selling, and how are we positioning ourselves going forward to make sure that those underlying drivers that are going to produce the best returns. For some periods, it might be multifamily and it might be single family rentals, but for other periods, it might be industrial that's going to outperform, or the grocery anchored retail sector. So it gives us the ability to be a bit more flexible in our investment management strategy. That tends to translate to lower volatility and better risk adjusted returns without having to actively manage the problems that come with buying and selling real estate on your own.
Understood. That's phenomenal. I was I just was in another call a little while ago, and they're talking about the spend in the AI space, about $500 billion. If you think about the seven darlings, if you will, those companies combined, almost $500 billion going out, basically investing in infrastructure, which would be real estate, data centers, things like that. What's different about you folks, and I think there are from our offline conversations, but coming into the pandemic, it was kind of an opportunity to retool. Some of the competitors out there didn't adjust their cap tables and things like that. But what was your guys' view coming? Obviously, I think with the pandemic, nobody really knew some of it would be sticky, but you guys were pretty effective in pivoting at that time, and took it on the chin where you needed to and just repositioned in a logical way. But maybe if you could talk about, like, kind of without naming names, but just how the industry and you guys are a little bit different.
Yeah, absolutely. Happy to. I think you have to start before the pandemic to really understand how we got positioned the way that we were positioned during and following the pandemic. And one of the unique things about DWS real estate is that we rely very heavily on our research driven approach. And twice a year, we publish what we call our real estate house view. And that informs how we go about portfolio construction in all of our underlying real estate strategies. And if you think back to 2018, 2019, a lot of economists and market participants were saying, well, this economic cycle has really been elongated. And at some point, there has to be some type of economic slowdown. And for us, what that meant was getting more defensive in our portfolios. So the focus became more on what is going to provide stability in the event that we do see a soft patch in economic activity, because at the end of the day, real estate houses the economy. Economic growth is what drives real estate returns historically. And one of the sectors that we were looking at in the leading up to the pandemic that we were looking to underweight was the office sector, because office tends to be the most pro-cyclical of all of the sectors that we invest in. If you think about employment and employment creation in the US, it tends to be driven towards office using jobs. And that's what drives the office returns that you see. So we were really focused on underweighting the office sector, anticipating some type of economic slowdown, not necessarily a pandemic breaking out and shutting down the global economy.
Right.
So we made that decision. And alongside of that, we saw the tailwinds that e-commerce had been providing to the industrial sector. And we were laser focused on overweighting that industrial segment, and also looking at multifamily and saying, well, since the global financial crisis, housing has been underbuilt in this country substantially, and there's a shortage of homes. So that multifamily rental segment is something that we were looking very keenly at investing in. And that's what informed the transition of our portfolios to being overweight industrial, overweight multifamily, underweight office, and that's continued to play out. And I think when I look back at what has driven the positive outcomes that we've experienced to date and has us in the position that we're in today to capitalize on what will be the next cycle of the real estate market, it's really that research-driven approach that looks at what are going to be the drivers of returns going forward and how can we capture those returns. And to the extent that we do see economic volatility, what is going to be most immune to that? And there's no better example than grocery anchored retail, which has, historically been one of the most defensive subsectors of the real estate market, because the consumer in the US drives 2/3 of economic activity. And what they don't stop spending on is going to the grocery store or going to the eye doctor or the foot doctor when something goes wrong. And we've seen a reinvention of the retail market, generally speaking, in the real estate space, where the goods providers have now transitioned to be service providers at a lot of those grocery anchored centers to drive traffic and therefore sales to the retailers and therefore rent growth to the owners of that retail. And even in the office segment, it's important not to throw the baby out with the bathwater. Class B office has been materially challenged. The major metropolitan areas that have been affected the most by work from home have suffered. But if you look at the other side of the coin, you have things like medical office, which have been very much defensive and very well leased and have demographic drivers that are underlying them. So to answer your question, I think it's our research-driven approach that has led us to be positioned the way that we're positioned today. And then it comes down to execution, having the right transactions team, the right asset management team, all collaborating with the portfolio managers to make sure that we're executing on the property level strategies and the portfolio level strategies, and how that all comes together in our investment process has been the primary driver of why we've found ourselves to be in the position that we're in today.
Interesting. John, as you know, the Fed, there's been some hot inflation numbers that have been printed, and coming into the year, there's a lot of kind of projections about 3, 4, 5 rate reductions, probably some more bank failures around that Class B commercial space potentially. Where is your view? Like, is this going to be a headwind or another tailwind for you when interest rates kind of are stagnant and staying close to where they're at? And again, with the likelihood or potential that there's some more bank failure with that, ownership of that asset class, would that be something that you see as a benefit or another headwind for you?
Yeah, for us, not so much of a headwind. We take a very pragmatic approach to our valuation process, and there's a lot of governance that goes into how we strike the valuations that we strike. So we have an independent third-party valuation expert that values all of our properties independent of what we do internally every single quarter, and more frequently if the markets are evolving rapidly. So we're in a position today where we've, as I'll put it, taken our medicine on the values, right? When interest rates were at 0, real estate yields being at 3, 3.5, or 4% were still very much attractive. But now with a Fed funds rate of 5.5%, those yields on real estate have had to adjust materially. And we've adjusted the valuations commensurate with what we've seen with the cost of capital and the cost of debt increasing. So in our view, interest rates shouldn't be so much of a headwind going forward for us to the extent that we're at peak interest rates. So on a go-forward basis, what we're looking at today are the highest yields that we've seen for private real estate assets in a decade. And for us, that's an indicator that it might be a good entry point, specifically if we do think that we're at peak interest rates today and inflation, although elevated from or maybe not elevated, but hotter than anticipated from a market's perspective. If those rates continue to stay where they are today in what we'll call restrictive territory, we don't think that'll be a headwind for our valuations going forward. And on the flip side, you've got the most attractive yields that we've seen in a decade to be investing in the private real estate market.
Interesting. Well, I just want to remind our viewers, this is not meant to be advice. You want to consult with your tax people and make sure any of these strategies are appropriate. But we'll put some information on the link about DWS and their team and some local folks that are kind enough to educate us all the time and be resources for our clients that, either have this approach or are trying to transition out of doing it themselves into kind of a more flexible, more liquid type of approach. Is something that a lot of folks like to have versus the do-it-yourself. And just kind of very quickly, do you compare yourself to this REIT benchmark asset class, or when you're looking here like 2019, like you said, this is where you started to do your transition, couple year before the pandemic, and then that helped you obviously a lot coming in. But do you guys compare yourself to one of these asset class matrix or something different?
We do look to the REIT market, the public REIT market, as an indicator of what is to come for the private markets. But what you tend to see in the public market is a lot higher correlation of public REIT returns and stock market returns, just in and of the fact that they're both publicly traded, and REITs in the public space tend to behave like equities, given how market forces will drive total returns. In the private real estate market, you tend to see those returns be substantially less volatile because of the fundamental valuation process that we go through.
Yeah, so would this benchmark be like, do you see a lot of S&P or like Russell type companies that are comprised, so they're really mimicking the equity results very closely? That's what's going on there?
Yeah, if you look at the S&P 500, real estate comprises approximately between 2 and 3%, depending on the market environment of that index. So it's a small percentage of the index, and you'll see that those REIT returns will be typically highly correlated with the equity market returns, more broadly speaking. So we do look to those REITs as a proxy for private real estate. What you tend to see over multiple cycles is that the public markets are typically a leading indicator. When the public real estate markets sell off, it might be an indication that private real estate returns are going to be softening in the future, and vice versa. When returns come back, as we saw in 2023 for the public real estate market, an indicator that maybe it's the beginning of a new private real estate cycle, as well as those valuations were adjusting last year to the higher cost of capital and higher interest rates.
Yeah, it's great. John, well, I'm about to wrap up. I couldn't really get my Kramer geek on just because I was enthralled with your explanation of your space and all that. So maybe when I get you back, I'll get a little bit more crazy personality stuff. But thanks very much for your time. I appreciate this. This is phenomenal. For any of the listeners that want some information about this concept, you can just DM me or contact me directly. But thanks again, and we appreciate your time today.
Thanks, Mark. It's always a pleasure chatting with you.